all indices are not created equal. There are key differences in methodologies. For example, in order to be a member of the S&P 500, there are certain profitability criteria, and if you're a large stock that's never made a profit, you're not included in the S&P 500. That might sound like a small difference, but aggregated together, the art of index construction can actually lead over time to big differences in the end results. At the heart of our index process, as well as the methodology document, there's also the index committee. And they will deal with decisions like which countries might be classified as developed or as emerging. They'll also deal with changes to the methodology. Our indices are a combination of a listed set of rules and an index committee that reviews those rules and makes those decisions which we don't yet have rules for. I think there are a couple of reasons why the S&P 500 has grown to take the role that it has today. Number one on those is its history. Indices are really about data and about measuring the markets. And the most important thing is you want to be able to study history. How has the market done under Republican or Democrat administrations? That's something you need a long history for. I think that the second piece is its comprehensiveness. It doesn't cover the whole market, but it is a broad collection of stocks that actually includes quite a diversified basket. And the third piece is probably the ecosystem that's developed around it. The first index fund to have any real traction was linked to the S&P 500. Futures are now listed and trade with a lot of volume based on the S&P 500. You can trade options on those futures, and those options form part of something called the VIX, known as the market's fear gauge. So there's a lot of traders, investors, commentators, and historians who have adopted the S&P 500 as their measure for the US market.